The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to our webinar on Roth employer contributions for our owner-only plans. First, a quick disclaimer that this information is generally of a non-legal nature and should not to be substituted for legal advice. If you need legal advice, please consult an attorney or an accountant as necessary. Today's presentation is primarily going to be focused on our owner-only plans, and we will concentrate on those particular plans for which Nova is actually the third-party administration firm. So the ones where we handle the 5500 preparation, the testing, and so forth. We'll go through a quick introduction to Secure 2.0, talk a little bit about some of the Roth initiatives that were passed under that law, and then get to some frequently asked questions. So Secure 2.0 passed in December of 2022, right at the end of the year, and included quite a few sweeping changes in addition to the Secure 2.0 or the 1.0 plan. And additional guidance was released even more recently, a grab bag, if you will, in an IRS notice that added some additional guidance to the Secure 2.0 provisions where practitioners had questions about how certain provisions should be interpreted. The primary application for the owner-only plans is that today we're going to talk about the Roth employer contributions, and but the possible tax credits is not in this particular presentation, but we're having a separate recording on tax credits. So let's talk a little bit about what we call Rothification. It affects employer contributions, and Secure 2.0 also had new law changes for catch-up contributions, employee contributions, if you will. So under Secure 2.0, employees are permitted to designate vested, matching, and non-elective employer contributions as Roth after-tax contributions effective in 2023. So this is intended to be a revenue-raising provision. The Secure 2.0 Act released a lot of other provisions that gave tax advantages to 401k plans and retirement plans. And this particular provision in the IRS and Congress's viewpoint was meant to pay for some of those other provisions by raising tax revenues. Also, a lot of our only plans are only interested in pre-tax, but there are some that are interested in Roth, which include both, backdoor Roth IRAs and other kind of backdoor Roth conversions, also Roth conversions within the plan itself. So we felt it would be a good idea to talk about some of these in our presentation. So for participants to be able to elect Roth, first, the investment providers or the record keepers we work with need to be able to support the feature. Then there will be a plan amendment required in order to offer this particular feature in a 401k plan. And third, the employee has to make an election to designate certain contributions as Roth. Very few of our Nova clients actually use a daily record keeper, such as some of our partner firms, Empower, John Hancock. We have about 10 or more partner firms that have daily record keeping platforms. These are only a few that we're mentioning, and most of our plans fall under the category that where Nova is the third-party administrator. And that means that we're doing the record keeping. We provide the benefit statements and the breakdowns between the different sources of money, the deferral bucket, the Roth bucket, if there is one, any employer profit sharing, and so forth. Whereas the daily record keepers would provide that function. And right now, what we found is they are generally not up to speed to support Roth employer contributions in their platforms just yet. There is a what we call a vesting issue here. The participant must be 100% vested in the entire money source. This was a clarification made in the grab bag that was released right at the end of December 2023, because this is a little bit uncertain. Could a participant, for example, that might be partially vested, elect Roth on just the vested portion of their employer contribution and put the rest of it in as a pre-tax? So in this example, if somebody was 60% vested, could they elect 60% of their profit sharing to go in as Roth and then the rest pre-tax? And the answer that came back from the IRS was no, this was not permitted. A participant has to be entirely 100% vested in a particular money type, whether it's the match or the profit sharing. Also, because this particular feature, this Roth feature, is not available necessarily to everyone in the plan. And I know we're talking about owner-only plans that generally just have one or two people in it. But let's say that the owner-only plan maybe hired some employees. Theoretically, there might be a benefits, rights, and features issue where a certain benefit was not available to everyone. And in most 401k plans, all of the features, the investment lineup, have to be available to everyone that's eligible to be in the plan. So it was uncertain whether this would be a problem, that only the 100% vested people could do this and everyone else couldn't. And the IRS clarified that there's no issue with that particular non-discrimination test, the what we call the BRF, or benefits, rights, and features test. So NOVA will be adopting what we call a sponsors level amendment on behalf of all of our clients. So this is an amendment where we're going to be adding a lot of the Secure 2.0 provisions in as defaults, and because of that, they're not going to be unique to each client. We're going to have certain defaults, and so long as the employers don't go outside of those, there's no need to sign this amendment. The Roth feature will be part of that amendment. Again, the amendment is not really due right now. It's due at the moment, unless they extend it again, by the end of 2026. But NOVA will be preparing that and make it available and send it out to our clients when we've got that ready to go. Right now, any new plan that's drafted that's an owner-only plan will have the Roth contribution feature included in that plan document, just automatically. So the other thing a client can optionally do is, if the owner or the owner's spouse is not 100% vested currently under the vesting schedule, we can amend that schedule to 100% vesting. That would be an optional amendment that would have to be prepared now and signed by the employer if they want to do this. So how does the participant go about making the election? The election has to be made prior to the contribution being allocated to their account. So think about allocated as being deposited, okay? The election is also irrevocable. So once they sign the election form, there's no going back. NOVA is going to provide an election form that will apply to both the match and the non-elective contributions. Again, this is for simplicity and to keep costs down on these very basic plans. Generally, you don't find plans making both styles of contribution anyway, but any election made will apply to both if an employer happens to be contributing both types of contributions. Also, the employer is going to be responsible for keeping track of these forms and reporting them and sending them to NOVA. So if a participant doesn't make any election, the employer contribution, if any, that's requested by the client will be allocated as a pre-tax employer contribution and go into that specific money source and bucket. All right. So just a reminder, even the owner-only plans really should have participants complete deferral election forms. That's best practices. I know a lot of Our clients don't do that, but as advisors, I would recommend that the owners also make elections as to what they want to contribute, so that everything's on file. In terms of taxation, the IRS has come back and indicated that this type of contribution is not going to be considered compensation for the year, like taxable compensation that's subject to FICA and federal unemployment tax. So the way it's going to be taxed is the plan is going to have to issue a 1099-R to the participant that makes a Roth election, and none of that income is going to be reported on the W-2 form. So this is very much like this is exactly what happens when a client makes an in-plan Roth conversion election. A 1099, basically any pre-tax Roth that's converted in within the plan has a 1099 issued. At the end of the year in which the conversion is made, and is considered taxable income at that point. In terms of the employer contribution deduction, that's going to operate as it always has under the same rules as before. So the way it works currently and will continue to work is the deduction is taken for the plan year for which the employer contribution is allocated. So it's not the deposit date. If we are calculating an employer contribution for 2023 and the contribution is allocated in 2024, then the deduction will be taken for the 2023 plan year so long as the employer has deposited or funded the employer contribution by their company extended tax return. So whatever that is for their entity, so long as they make that deposit before they file their company return, which is usually in the following year, obviously, then it's deductible in the prior year. So the employer contribution is taxed again in the calendar year allocated. So for the employee, it's taxed in the calendar year in which it's allocated, which it's deposited. It's a little bit different than it is for the employer. So some of that timing may confuse your clients. It's important to be able to explain this. The employer contribution deduction is going to be in a different year than the taxation to the participant. So just an example, like I was talking about before, if we have a plan that wants to make a 2023 profit sharing contribution, that contribution is typically decided on in 2024, and then what would happen is the owner would have to make an irrevocable Roth election prior to the funding of that contribution. All right, and in that situation, the employer gets the deduction for the prior year, again, assuming that they funded it prior to their tax filing deadline. The participant gets taxed on it in 2024, and then they'll get a 1099-R in January of 2025, which is when all the 1099-Rs are due. Okay, so any clients that we do have some clients that like to fund their employer contributions as they go during the year. If you have a client like that, they're going to need to report these contributions to us by early January. So, if you had somebody that had designated an employer contribution prior to making it in 2023, as an example, right? By early January of 24, we're going to need the special election form that they signed on that so that we can issue a 1099-R, right? Now, pre-funding like that is not recommended, just so you know, for a variety of reasons. As you can see, this kind of can be a problem in terms of getting the 1099-Rs out on time if you have clients that are doing this and actually want to make or designate the contribution as Roth. The other problem is that you don't want clients really pre-funding their contributions during the year, especially their profit sharing, because the income for the year has not been determined, like how much they made. And if they fund too much, then they could be subject to non-deductible contribution penalties. So we never recommend a client sort of pre-fund. Now, if they're making a match, typically a client will make a match throughout the year, and that we would recommend if you're talking to clients that want to be doing that. That's not going to work well for a match. A match made on a payroll by payroll basis, um, functionally is not going to work very well, because how do you make the election on a payroll by payroll contribution before it actually gets funded each pay period, right? I mean, that can be problematic. So um, we don't recommend them doing that on matching contributions. So additional fees will apply to the 1099Rs. There's extra work for us to do. Um, and if there's no, again, all of this Roth election stuff is completely optional for the client. So if they don't want to utilize the feature, that's fine. It's going to be included in the plans, but no additional action or fees are applicable if they don't want to use the feature or don't want to make an election. In addition to employer Roth contributions, the IRS has also required that any employee that makes more than $145,000 in the prior year will have to fund their catch-up contributions as Roth. Now, luckily, because of the complexity of this, we have an administrative delay that delayed the start date of this particular feature until 2026. But just understand that it is coming. So anybody within that income range or above it, again, this is applying to our age 50-year-olds and older, will have to have their catch-up contributions go in as Roth contributions, and that's not an option. Okay. Currently, this only applies to the corporations, and they, for whatever reason, Congress did not apply this particular rule to partners and sole proprietorships. So what are we doing? All of Nova's owner-only plans already have a catch-up feature written into the plan, so there's no extra plan amendment required for that. If this issue is 100% handled in payroll, then no additional fees are going to apply, right? This is for the catch-up contribution issue. A lot of this is going to require some payroll system updates, and that's why the administrative delay was granted by the IRS. And if catch-up contributions have to be recharacterized for some reason as Roth, then additional fees will apply. This happens if there were failed non-discrimination tests that would require a recharacterization of pre-tax contributions as Roth, which happens sometimes. Typically, this doesn't occur in an owner-only plan. So we will be, obviously, we're targeting you as advisors with this webinar, but we will be holding additional webinars for our plan sponsors here in the very near future, and we'll be sending out additional communications to them about our initiatives and what's available to them. So we just wanted to have this webinar available first, so that if you get questions from them, you'll know what Nova's procedures are going to be. At this time, we're not going to talk to them about the Roth catch-up, since it's not available or required to be implemented until 2026. But we will be having additional webinars on that as the deadline date draws closer. In terms of the fees, there will be no special amendment fee at this time. Again, we're including the Roth employer contribution feature in the plan now, and there will be, for the existing plans, a sponsor level amendment to come in the future. The 1099s, our normal fee for those is $125 per form, so per form per year. Also, per our engagement agreements, we charge an extra $100 per source, record keeping source. So if you can imagine, individuals have benefit statements that have deferrals, possibly Roth deferrals, then now you're going to have pre-tax profit sharing. You could have Roth profit sharing, so forth and so on. So for each line item that there is, we charge $100 for each source. So we'll just get into a few frequently asked questions before we close out the webinar here. Again, now why can't Nova support the Roth employer contributions for our larger daily record keepers and investment providers? Again, the guidance on how the taxation was going to work, was it going to be W-2 income, when somebody made a Roth election, or was it going to be on a 1099? That guidance only came out in December of 2023. So most of the record keepers have not, updated their processes and procedures for being able to provide the 1099s on that. Typically, it is the record keeper's responsibility to issue the 1099s, that consider certain distributions and then other, in this case, contributions as taxable income, right? I mean, that is what they do on their Roth conversions as well. So we'll keep an eye out for new announcements, and once they're ready, the Roth employer contribution feature will be available. But at the moment, in contacting our partner firms, doesn't look like any of them are quite ready for it yet. So can a owner-only plan or a solo 401k plan still make a Roth election for 2023? Obviously, we're in 2024 now, right? So as the example that we had previously indicated, the answer is yes. The contribution is taxable in the year allocated, and so long as the employer has not filed their company tax return yet, they can still take a deduction for an employer contribution, in the previous year, even though it's allocated this year. It's just the taxation of the participant and the deduction are going to be for different years, so they can still do it. If a client has already funded their 2023 contribution and now wants to designate it as Roth, they can't do that, right? Because the Roth contribution has to be designated before it's allocated, before it's funded. But what they can do, and what's available in the plan document, is they can always convert the Roth, the pre-tax contribution to Roth within the plan, and this has been available for some time now. So this is just the process that we know at this point, and so they can still do that. Just keep in mind that in both scenarios, the taxes cannot be paid from the plan assets, from the contributions or the money that's in the plan. So they're going to have to pay the tax when they go file their tax return for any kind of a Roth conversion within the plan. So if somebody took or converted $100,000 right now, they'd have to have the cash flow and money on hand when they went to file their taxes a year from now. Okay, so this feature again is available in the plans already, and the same fee would apply to the issuance of the 1099 showing any conversion is taxable. Are all owner-only plans required to add Roth contributions, employer contributions? Yes, we're going to add this feature automatically for them and not make it an option. Again, this is just to keep amendment costs down, right, and keep the simplicity of these plans in place. We're trying to keep the fees as low as possible. This also gives them complete flexibility to make the contribution, but they don't have to designate Roth contributions. So will adding a Roth employer contribution increase the base fee for the plan? This is all determined by the employer engagement agreement, but in general, the base fee is not going to increase at all. again, some of these agreements can be written differently than others, but there shouldn't be any increase there. We talked about the increase for each money type, again, $100 per line item. Now, to the extent maybe some line items go away, let's say we convert all of our pre-tax deferrals or the pre-tax profit sharing to Roth, and now your pre-tax line items go away, there could be some cost savings there, but for every different record keeping line item, there will be an additional charge. So, in terms of how the election will be made, we're going to supply the sample notice and the election form that each owner needs to sign and turn into us. And the employer is going to need to pass that form out and then keep track of it as well. And then the employee will, to the extent there are any employees or maybe a spouse involved, they complete the form. Does the employer need to get new election forms for each Roth employer contribution? No, an existing election will remain in place until the employee changes it, and just remember that employees need to be given the opportunity to make an election at least once a year. Again, most of these plans have no employees, so as I reference employees, I'm talking about the owners and their spouses and or family members. Can a participant election be made after the contribution is allocated? And the answer is no. Again, the designation has to be irrevocable and it has to be made before the money is allocated. Is NOVA going to track participant election forms? No, it's going to be the responsibility of the employer to maintain these forms and keep them on file in case they get audited anytime. So for any owner-only plans where we're the record keeper, there will be an additional employer election form that will be collected in December in order to complete a 1099. Again, this is a reference to those plans that might be pre-funding their employer contributions throughout the year, and then maybe they made an election. We're going to need to get a copy of that pretty early, right before the year closes, so we can get the 1099-R out on time in January of the following year. Will any tax withholding be taken on the Roth employer contributions? No, again, there's no real functional way to do this. If you think about it, sending withholding into the government on an employer contribution is just not something that we can support, and so the participant is going to have to pay the tax when they go to file their personal taxes, possibly a year after the contribution is actually funded. Just so you know, this is just one short webinar on one Secure 2.0 provision. We have many other webinars that are available on our YouTube channel, and this is the link for that. So please feel free to visit that channel and watch any other webinars that we have posted. There'll be one shortly on the tax credits for owner-only plans. We have general webinars on Secure 2.0 as a whole, so feel free to look at that website. We appreciate all of your attendance today and appreciate your business.